Why is it so hard to say, I'm a long-term investor? At first glance, saying, I'm a long-term investor sounds simple, rational, mature, disciplined. In reality, it's psychologically, socially, and neurologically difficult. Here's a research-based breakdown of why. 1. The brain is wired for short-term survival. Human decision-making evolved for immediate threats and rewards, not 20-year compounding charts. Behavioral economist Daniel Kahneman explains this through System 1 versus System 2 thinking. System 1 equals fast, emotional, reactive. System 2 equals slow, rational, analytical. Markets constantly trigger System 1. Red numbers danger. Green spikes opportunity. News alerts urgency. Long-term investing requires sustained System 2 control, which is cognitively expensive and mentally tiring. Saying, I'm a long-term investor, means committing to override your evolutionary wiring. That's not easy. 2. Loss aversion hurts more than logic helps. Research by Daniel Kahneman and Amos Tversky shows losses feel about 2x more painful than equivalent gains feel pleasurable. So when your portfolio drops, the emotional impact is disproportionate. The pain feels urgent. Waiting feels irresponsible. Even if your long-term plan is intact, your nervous system interprets volatility as threat. Saying, I'm long-term, during a drawdown feels like standing still in front of danger. 3. Social pressure rewards short-term action. Financial media amplifies immediacy. Headlines focus on today's crash. This stock exploded. Breaking news. Social platforms reward predictions, fast trades, quick wins. No one goes viral for I stuck to my index fund for 17 years. The market culture rewards activity, not patience. Remaining long-term often feels like social invisibility. 4. Action bias creates the illusion of control. Studies in behavioral finance show that humans prefer doing something over doing nothing, especially under uncertainty. This is called action bias. In investing, selling feels like control. Switching strategies feels intelligent. Trading feels proactive. But long-term investing often requires strategic inaction. As economist Burton Malkiel argued in A Random Walk Down Wall Street, markets exhibit strong elements of randomness, making excessive trading statistically harmful. Doing nothing feels lazy. But statistically, it's often optimal. 5. Dopamine prefers excitement over compounding. Neuroscience research shows that novelty and unpredictability trigger dopamine release. Markets provide price alerts, earnings surprises, volatility spikes. Long-term investing provides slow growth, boring consistency, minimal stimulation. Compounding is powerful, but it's not exciting. Your brain prefers stimulation. Your wealth prefers patience. 6. Identity conflict, smart versus still. Many investors subconsciously associate intelligence with activity. Analysts are respected. Traders are admired. Market timers look skilled. But long-term investors often buy broad funds, rebalance occasionally, ignore daily noise. In fact, research from Barber and Odeen found that investors who trade more tend to earn lower returns on average. Yet culturally, inactivity feels unsophisticated. Saying, I'm long-term, sometimes feels like admitting, I don't outsmart the market. That's an ego challenge. 7. Uncertainty is uncomfortable. Short-term trading offers psychological closure. You decide. You act. You see results. Long-term investing demands enduring uncertainty, accepting volatility, trusting probability over prediction. It requires humility. And humility is psychologically harder than control. 8. The time gap between cause and reward. Long-term investing separates effort today, reward years later. Humans struggle with delayed gratification. The famous Stanford marshmallow experiment demonstrated how difficult it is to wait for a larger future reward. Investing is the adult version of that experiment. Except instead of 15 minutes, it's 15 years. 9. Market narratives change constantly. Every year brings new technologies, new crises, new paradigm shifts. Staying long-term requires ignoring persuasive narratives. During bubbles, long-term investors look slow. During crashes, they look stubborn. Consistency is rarely glamorous in real time. 10. It requires emotional discipline, not just strategy. Anyone can say, I invest for 20 years. But the real test happens when the market drops 30%. Your friend doubles money on a hot stock. The news predicts catastrophe. Long-term investing is less about knowledge and more about emotional regulation. It's behavioral. Conclusion. Saying, I'm a long-term investor, is hard because it means resisting evolutionary instincts, accepting uncertainty, enduring volatility, ignoring social pressure, delaying gratification, suppressing ego. It is not a financial statement. It is a psychological commitment. And that's why most investors say it easily in bull markets, but struggle to mean it in bear markets.